Let's welcome in Trivariate's Adam Parker, CEO and founder of Trivariate Research, a CNBC contributor at Post 9. It's good to have you back.
Thanks for having me.
Are you dialed in on credit and loans and all the things that people are talking about outside of the stock market?
It's definitely coming up in a lot of my meetings. It's polarizing. I think most people, the consensus among the institutional investors is this is going to pass. We're going to get locked in on earnings. I don't even think it's next week. It's the earnings the week after. Like all the big tech stuff, Visa, MasterCard, kind of more like 10 days from now. So I think people are thinking maybe, a little bit isolated, some of the...
Idiosyncratic. That's it. So you would answer before I brought you in, I said idiosyncratic or, more to worry about. You go with the former.
I think it's gonna pass pretty quickly. I do.
What makes you believe that?
I just think we're not seeing it from the bigger institutions. So our view is own the large cap, higher quality banks. I think the regional banks are more of a economically sensitive interest rate play that I don't love right now. They're more likely to, be affected by loans that are bad. I think the big guys can absorb 50 million losses here or there, and you don't see it. I don't even know if JP Morgan, bends over to pick up 50 million. So, I think it's probably not going to affect the bigger banks as much, and I think that's a safer way to play it. On the flip side, I think the earnings season from the big banks, which was really before the whole, First Brand and Zion stuff, was pretty darn solid, right? If you look at it, generally upper revisions, a little bit more provisioning, but they didn't do as much last quarter. I kind of looked at the bolus of the big bank earnings and thought they were pretty solid. So I can kind of stick with that as the thing I'm most focused on. I mean, Jamie Dimon saying the consumer looks like it's pretty good. Monahan at Bank of America. If you look at what they're saying,
I don't think... But he also talked about, cockroaches when it comes to credit.
Totally.
Right?
Yeah. I appreciated that sense of humor, but I think if you kind of look broadly across lending and demand for loans and what's being borrowed and what's being returned, it still looks pretty good. So I think the answer is the way you pitched it, it's more idiosyncratic. I think by the middle of next week, we'll be talking about Mag 7 earnings on the horizon, Visa, MasterCard, the other consumer, and we'll be back to the AI focal point. I mean, Taiwan Semi this week, a little bit ignored, but pretty good numbers. So I think there's enough in the fundamental positive camp that we'll get through this. Credit is always going to be considered the canary in the coal mine after a huge rally in stocks. Sure, it makes sense you get a couple days of fear, but as you see, people want to own the good quality names into what I think is going to be a pretty good earnings season.
Wow. And the Mag 7 are going to remind us why we want to stay with those names?
Yeah, I think so. I think the earnings season is risk-reward skewed to the positive. I think the biggest risk I see is that the return on the hyperscaler capex is so good they raise their capex even more. And so the school of people that are out there that I'll profile by saying older value investors have been more skeptical of AI productivity than younger growth investors. Obviously, there's exceptions, but I'd say that's how I'd cluster the group that I talk to. And I think the older value investors would say the return's obviously not that great, the capex is crazy, ultimately that's going to be bad. They may be right for the wrong reasons if the capex goes up. I think it's more likely the return is awesome for a while, and that the companies want to spend more capex, take the cash flows down to zero or negative, and so you could get a little kind of freak out on that. But I think ultimately you're going to be back to this stuff works and it's good and things can go higher.
What about the idea, even if you dismiss the credit issues as being not even to the level of systemic, but even more of a worry than they are now, does it tell you in any way about where we might be in the cycle? That when you get to a certain point in the cycle, you start to have issues like this because you talk about excess, the incredible demand for leveraged loans, and then the lending standards are lower at the closer to the end than the beginning. I mean, how do you look at that?
I'd answer that a little bit differently, and I want to make it seem like I'm talking on both sides of my mouth, but there definitely are late cycle trading signals happening. If you look at like the number of stocks that are up 100% or more in the last 6 months, and just things that maybe everyday investors don't look at, Oklo or, just the huge moves in these names that are either pre-revenue or don't have a lot of revenue. Rigetti in the post-quantum, cryptography, quantum space, Ionic. Like the moves have been massive. Bloom Energy, like anything with any AI data center sort of dream is up 300, 400, 500, 600%. So you don't see tops blow off things like that as part of a normal way. And so actually the note we're working on for the weekend, we write one every Sunday is, let's compare this to the October 99 through March 2000, just on some of the trading dynamics. I don't think that's The exact thing is where we are in the lending cycle. I think we're still earlier there. I still think private credit demand is going to grow. I think people are putting products together for that. So I think we're earlier in the credit cycle than we are on just some of the kind of crazy valuation trading cycle.